Hello everyone, Clifford Bennett, Chief Economist at ACY Securities. I trust you are having a good day. It's been a lot happening around the world. We've seen some rather dire PMI data in Europe. We've seen factory orders in the US drop 2.1%, ongoing contraction there in the manufacturing industry. And we continue to see, though, that the ECB and the Fed are keen to raise rates further if they need to in the US, and it looks like they most definitely will in Europe. So the outcome going forward is not going to be good for either of those major economies, and this comes as China continues to weaken. Yet Australia's GDP data managed to do quite well, up 0.4% in the most recent second quarter, which gave the full financial year a result of 3.4%, which is an above-trend growth rate. Of course, we're going to see some slowing in that data, but with capital expenditure and exports doing well, and the slowdown in China further softening the Australian dollar, we should see that Australian dollar decline actually compensate for any reduction in exports to China. And of course, that weaker Australian dollar gives us strong support and price advantages as our current Prime Minister travels to Indonesia today to begin his campaign for greater trade situations throughout the Asian region outside of China. Politically, or diplomatically, that's a brave sort of role to be taking on, because China will see that as yet another snub by Australia trying to isolate it in some ways. So we could see some repercussions there, and it would certainly look to slow what were warming relations with China. Again, though, I have to emphasize that weakening Australian dollar is going to be good for the export sector. But what I fear, given that the per capita number was down 0.3% last year, is that we're actually going to get a situation similar to the GFC, where the aggregate data continued to look strong, yet at that time, New South Wales and Victoria actually fell into recession. So it was a case of the export sector growing at a phenomenal 16%, that made the aggregate data look good. But of course, only 3 to 5% of Australians work in the mining industry. So the aggregate data can look good while much of the population experiences a recession. And I feel that that's where we're headed at the moment with the Australian economic data. And I note that some other economists have said similar things today, that this data one should start to take with a grain of salt, as the exports boosting the situation for 3 to 5% of Australians actually isn't the real picture. So I think the Australian economy is still in some peril, if you like. Certainly the retail sector is feeling the pinch at the moment. There's a lot of anecdotal evidence about the building industry, of course, which is probably already in recession. And our manufacturing sector looks to be in recession as well. And I think we will see that in forthcoming data. So whilst today's GDP number is worthy of celebration, it really is a sign that the RBA can continue to maintain very firm interest rates where they are. And if there were a rekindling of inflation, the RBA could raise rates even further. And that would be likely if energy prices continue to rise, because we're going to see further increases not only at the petrol bowser as global oil prices move significantly higher, but we're also likely to see increased electricity supply to homes going higher as well, and to businesses, of course. And that will eventually sharpen the inflation numbers as well. So whilst we've seen rather sticky, they call it, inflation in the United States, especially in that core inflation data, I think that might be something we begin to see more of in Australia. Certainly inflation has already plateaued at a too high rate in Europe, and perhaps we will yet see that happen in Australia as well. So this is not an overall really great outlook for equities in Australia, and they are showing signs of the recent rally beginning to fail and the market beginning to move lower. So I would suggest, even though I've been saying it for a while, well, it's been working over the last few weeks, that a defensive approach to equity exposures is still appropriate. I hope you have a good day, but at least we can have a drink on the back of that GDP number being above expectations.